Your neighbor just told you he's got $2 million saved for retirement. You congratulate him. He seems proud, upper class, right? Comfortable. Then your other neighbor mentions she's got 3 million. Even better, she's driving a Lexus, taking trips to Italy. You're thinking, okay, these people are set. They're in the 1%, except they're not even close. So I'm gonna break down exactly what net worth actually puts you in the top 1%, the top 10%, and what most people don't realize about the middle. And I'm going to explain why the whole ladder is built on psychological tricks that keep you climbing in the wrong direction. Because the data shows something uncomfortable. Most of what you think about retirement wealth is just wrong. Here's my central metaphor, and I'm going to keep coming back to it. Think of retirement net worth like a multi-story building. Most people think they're trying to get to the penthouse. They imagine the 10th floor is pretty good, the 20th floor is great, and somewhere up there is the top. But what they don't realize is that the penthouse isn't on the 20th floor. It's not even on the 50th. The real penthouse is on floor 217. And every 10 floors you climb, you look around, you see nice furniture, you think you've made it, and then you realize the incentive structure of the entire building was designed to make you feel successful right where you are, so you stop climbing. Or worse, so you take on debt to furnish your current floor instead of saving to go higher. Let me start with what the Federal Reserve's Survey of Consumer Finances actually shows. This is done every 3 years. The most recent data is from 2022, and it covers households aged 65 to 69, right at the retirement threshold. The bottom 25% of retirees, what some sources politely call financially vulnerable, have a net worth of $69,500 or less. And yeah, that includes home equity for the 80% of retirees who own a home. That's everything. Their house, their 401k, any IRAs, savings accounts, the whole pile. Now you're asking yourself, how does someone retire on $70,000 total? And the answer is, they don't, really. They survive on Social Security, maybe a part-time job, maybe help from family. The system doesn't call this a failure. It calls it the bottom quartile, like it's a neutral fact of life. The next layer up, the 25th to 50th percentile, ranges from $69,500 to just under $400,000. So if you've got $395,000 in total net worth at retirement, you're precisely at the median. Half of American retirees have less than that. Half have more. The median household retirement spending, according to the Bureau of Labor Statistics, is about $60,000 a year as of 2024. You do the math on how long $400,000 lasts if you're pulling $60,000 a year, even with Social Security filling some of the gap, and you start to see the problem. The building's foundation is cracked. Let me tell you a story. I know a guy, we'll call him Dave. Dave worked as a regional manager for a logistics company for 30 years. Good job, decent salary, he saved a bit in his 401k, maybe 10% of his income when he could. By the time he hit 65, he had about $380,000 saved, plus he owned his home outright, worth maybe $200,000 in a mid-tier market. So, total net worth, $580,000. He thought he was doing fine, better than most of his buddies. And statistically, he was. He was above the median, solidly in the 51st to 75th percentile range. But here's what nobody told Dave. Being above average in a system designed to underfund retirements just means you're the least screwed person in a screwed cohort. Dave's plan was to pull about $50,000 a year from his portfolio and Social Security combined. Sounds reasonable, except inflation wasn't part of his plan. Neither was a healthcare surprise in year 3, a surgery his insurance mostly covered, but the out-of-pocket was $18,000. Suddenly, his safe withdrawal rate wasn't so safe. By year 7, he's back working part-time at a Home Depot, not because he wants to, but because the math stopped working. The system told him he was middle class in retirement, and technically he was. That's the floor he was on. But middle class doesn't mean comfortable anymore. It means you're one surprise away from a problem. Now let's climb higher in the building. The 75th percentile, the top of what we'd call solidly middle class, sits at about $1.2 million in net worth for retirees. According to Kiplinger, if you're aged 55 to 64, that number is 1.12 million. Age 65 to 74, it's 1.2 million. If you've got that much, you're wealthier than 75% of retirees. And here's where it gets interesting, because this is the floor where people start to think they've arrived. They've got a paid off house worth 400,000, maybe $1 million in their portfolio. They can withdraw 40 to 50,000 a year safely. They've got Social Security adding another 25,000, and they're living on 75,000 a year. They're traveling. They're helping their grandkids with college. They feel wealthy, but they're still not even close to the top 10%. To crack the top 10% of retirees, you need $2.9 million. Let me say that again, because this is where most people's mental model breaks. $2.9 million in net worth puts you in the top 10%, not the top 1%, the top 10%. You're on floor 29 of the building, and you look down and you can't even see the ground anymore. You've passed the median by more than 7 times. You're wealthier than 90% of retirees, and you're still not even in the conversation for the penthouse. Here's a quick cutaway. Imagine you're at a retirement party. Guy gets a gold watch, everyone claps. Someone asks him what his plan is. He says, I've got 3 million saved, I'm gonna travel, play golf, enjoy life. And there's always that one guy in the back, the financial advisor type, who thinks to himself, top 10%, cute. Because he's seen the real top. He knows 3 million is comfortable. It's very comfortable, but it's not elite. Elite is a different game entirely. The psychology of this is fascinating, and it's where my 10+ years running a business and talking to accountants and fiscal lawyers actually taught me something useful. The human brain is terrible at scale when it comes to wealth. We think linearly. We think, okay, if 1 million is good, 2 million is twice as good, 3 million is 3 times as good, and so on. But wealth doesn't work that way. Wealth compounds. Wealth creates access. Wealth changes incentives. And the distance between 3 million and 20 million isn't just a bigger number. It's a different universe of financial behavior. To hit the top 1% of retirees, you need $21.7 million or more in net worth. That's floor 217 in our building. And here's the kicker. When you're at that level, you're not just rich. You're in the can charter a private jet without thinking about it tier. You're in the can donate $1 million to a cause and not feel it tier. You're in the your money makes more money in a year than most people earn in a lifetime tier. I've worked with people at this level, back when I was surrounded by clients with serious portfolios. And the thing that struck me wasn't their spending, it was their calm. When you have 25 million, there's no financial decision that stresses you. None. You don't look at restaurant prices, you don't think about flights, you don't worry about healthcare costs in retirement. The system is no longer something you navigate, it's something you own a piece of. But now you might be thinking, okay, so the numbers are big, but how do people actually get there? Because the gap between 1.2 million and 21.7 million is $18.5 million. That's not just saving 10% of your salary for 40 years. That's something else. And here's the reversal. You think the difference is income. You think people at the top 1% just earned more. And yeah, income helps. The Tax Policy Center shows that to be in the top 5% of wage earners in the US, you need to make just under $300,000 a year. That's household income, not individual. So a couple each making $150,000 gets you there. But here's the thing, income is not net worth. I've met people who earned $400,000 a year for 2 decades and retired with less than 2 million. I've also met people who earned $120,000 a year for 3 decades and retired with 8 million. The difference wasn't the income, it was the savings rate, the investment decisions, and most importantly, the incentive structure they built for themselves. Let me tell you another story. 2 guys, both engineers, both worked at the same aerospace company from the mid-90s until 2015. We'll call them Mark and Jeff. Mark earned about $130,000 a year. Jeff earned about $150,000, $20,000 more consistently for 20 years. That's an extra $400,000 in gross income over their careers. You'd think Jeff would retire richer, right? Wrong. Mark retired with $7.2 million. Jeff retired with $1.8 million. How? Mark lived in a house worth $300,000, paid it off in 15 years, drove a Toyota Camry for 12 years, maxed out his 401k every single year, put another $20,000 a year into a taxable brokerage account, bought index funds, never sold, never panicked in 2008, never chased crypto in 2017. Just bought the whole haystack, as I like to say. Let it compound. Jeff, on the other hand, lived in a house worth $700,000, upgraded cars every 4 years, leased a BMW, then a Mercedes, took expensive vacations. He was living like he earned $150,000 a year. Mark was living like he earned $70,000 and investing the difference. The math is simple, but the psychology is hard. Because the incentive structure of American consumer culture is designed to make you spend up to your income. Every time you get a raise, there's a nicer car, a bigger house, a better zip code. The system doesn't reward savings, it rewards consumption. Because consumption drives GDP, and GDP drives stock prices, and stock prices drive the wealth of the people at the very top of the building. You climbing from floor 5 to floor 12 doesn't threaten them. You staying on floor 12 and buying a nicer couch? That's perfect. That's the game. Let me give you a concrete case study with real numbers so you can see the mechanics. Let's say you're 35 years old right now. You want to retire at 65 with enough to be in the top 10%. That's $2.9 million in net worth. Let's assume your house will be paid off and worth $400,000 by then. So you need $2.5 million in invested assets. If you can average a 7% annual return, which is reasonable for a diversified portfolio of stocks and bonds, and you're starting from zero today, you need to save about $33,000 a year for 30 years. That's $2,750 a month, every month for 30 years. No gaps, no panic selling, no cashing out to buy a boat. Now, if you want to hit the top 1%, $21.7 million, let's say your house is worth $1 million by then because you're in a high cost area. You need $20.7 million in invested assets. Starting from zero at 35, at 7% annual returns, you need to save about $275,000 per year for 30 years. You see the problem? You can't save your way there on a normal salary. You need equity. You need a business exit. You need investments that return more than 7%. You need to own assets that compound faster than the market. Or you need to start with a lot more than zero. Here's another quick cutaway. There's a Reddit thread where someone asked, what's it like being worth $10 million? And one response stuck with me. The guy said, it's like playing a video game after you've entered the cheat code for infinite money. You're still playing, but none of the stakes feel real anymore. That's the top 1%. Different game, different stakes, different incentives. The Pew Research Center tracked this for 50 years, from 1971 to 2021. Back in 71, 61% of Americans were middle class. As of 2021, that dropped to 50%. 11 percentage points of change. 7 of those points moved up to upper class. 4 points moved down to lower income. The middle is getting squeezed. The building is getting hollowed out. You're either climbing to the top floors or you're sinking. Staying in the middle takes more effort than it used to, and the rewards are smaller. Here's where it gets really interesting. The road to $1 million is not linear. If you save $10,000 a year and earn 7%, it takes you 7.84 years to save your first $100,000. Most of that is money you contributed. The returns are small because the base is small. But the second $100,000, that only takes 5.1 years. Because now you've got 100,000 working for you. The third 100,000 takes even less time. By the time you're going from 900,000 to 1 million, it only takes about 2 years. Because at that point, 86% of your growth is coming from returns, not contributions. Your money is doing the work. That's the compounding curve. That's the soldier metaphor everyone uses. Each dollar you save is a soldier fighting for you. The more soldiers you have, the faster they multiply. But here's the psychological trap. It takes almost 8 years of disciplined saving to see your first 100,000. 8 years. That's a long time to feel like you're grinding with no visible progress. Most people quit. They don't see the exponential curve coming. They see 8 years of sacrifice for $100,000 and think, at this rate, I'll never get there. So they stop. They buy the car, they upgrade the house, they give up on floor 20 and settle for floor 8. The system wins again. So what do you actually do with this information? Here are 3 practical takeaways. Not generic, not motivational, just the mechanics. 1, ignore percentiles when you're young. Seriously. If you're 35 and comparing yourself to retirees, you're looking at the wrong data set. The median net worth for someone aged 35 to 44 is $135,000. If you're anywhere near that, you're not behind. You're average. The goal isn't to beat the average now. It's to build the system that beats the average in 30 years. Focus on your savings rate, not your current net worth. Savings rate is the only input you fully control. 2, understand the difference between income and net worth. You can't spend your way to wealth, even with a high income. The data is brutal on this. The top 5% of earners make $300,000 a year, but plenty of them retire in the 75th percentile of net worth, not the top 10%. Why? Because they spent it. The incentive structure of their peer group demanded it. They lived in the right neighborhood, drove the right cars, sent their kids to the right schools. All of that is consumption. None of it is compounding. If you earn $150,000 and save $50,000, you're wealthier than someone who earns $300,000 and saves $20,000. Every single time. 3, build your own incentive structure. The default system is designed to extract your wealth through consumption, credit card offers, car financing, home equity lines of credit. All of it is designed to make you feel wealthy while keeping you on floor 12. The only way to win is to build a counter system. Automate your savings so you never see the money. Live in a house cheaper than you can afford. Drive a car longer than feels comfortable. Make it automatic. Make it boring, because boring is what works. Lazy investing built more fortune than crypto memes. The top 1% of retirees have $21.7 million because they played a different game than everyone else. They didn't climb the building one floor at a time. They bought the building, or they built equity in a business and sold it. Or they invested early in assets that compounded at 15% instead of 7%. The path to the penthouse isn't a straight line. It's a series of asymmetric bets that pay off over decades. And if you don't hit 21 million, you're still probably fine. 2.9 million puts you in the top 10%. 1.2 million puts you ahead of 75% of retirees. The goal isn't to win the game. The goal is to not lose it by spending everything you make while the system tells you you're doing great. Most people will never see floor 200, and the system is counting on that.